welcome to After Hours at Traders Post for March 21st, not 2025. I almost said 1995 there, Mike.
Wow, that's
I'm
a
Tom
throwback.
Hartman. I'm Tom Hartman, the birthday boy, joined by Mike, Mr. Nasdastic Christensen, to dissect the market's biggest moves. After Hours is your go-to market commentary powered by Traders Post, the ultimate automated trading platform, but more on that later. Today, we're diving into these three stories shaking up the markets. Google makes a historic move to acquire Wiz. MicroStrategy doubles down on Bitcoin with new STRF shares. And has the S&P's wild ride potentially come to an end? Well, the bell has rung, so let's get into it. Because as traders, we don't just watch the news, we trade it. How's it going there, Mike?
Doing well. It's been an interesting trading session over these last few days here. A little bit of a roller coaster, up and down. I didn't even trade today at all. Tried to avoid it because it's kind of almost too much noise at this point, which to me represents a little bit of an interesting consolidation zone and could be support. But let's unpack that when we get to the S&P 500 pullback. It's part of the story.
Excellent. Yeah. Well, so let's start off with first. Google's eyeing Wiz in a deal that could redefine cloud and AI. But with Wiz's valuation skyrocketing and regulators circling, is the let's start out again, Mike. First, Google's eyeing this purchase of Wiz. So the
Yes.
issue here is that it's the biggest acquisition in Google's history, the single purchase in Google's history, and it actually would have still been the single biggest one last year when they were looking to buy Wiz at like a 22 or 24 billion-dollar valuation that Wiz walked away from. They decided, hey, let's go ahead. We think we can get more than that. Let's IPO. Let's get some private equity and see if we can raise our valuation. And they did.
I almost
They
wonder if we can pull this up real quick. I found this chart to be incredibly insightful so that you can sort of compare all of Google's acquisitions over the past to how big this one really is. In 2012, they acquired Motorola for $12.5 billion. And even adjusting for inflation, that was a fairly massive acquisition. And of course, DoubleClick was a really big one at the time in 2007. They weren't really all that big of a company yet, and they had really taken this big bet on DoubleClick. But this is massive. This one, takes a big chunk out of their free cash flow, and of course, I'm sure that they're financing the deal in a number of interesting ways. But $32 billion is a massive valuation for a cybersecurity company. Maybe we can cover some of the concerns there.
Yeah, well, the actually one of the reasons why Wiz wasn't acquired in 2024, even though they thought they could get a higher price, was that it was also in the face of, from what I understand, in the Biden administration, there was this issue of mergers and acquisitions that they wanted to prevent, like antitrust issues and monopolies, and so like Wiz didn't want to like jump into that fray and spend who knows how much time and money and effort trying to navigate that, and so they stepped away. The thing is, that concern might still actually be there with the Trump administration, like for different reasons. The Trump administration seems to want to, and we'll talk about this a little bit more later on, decrease the divide between the top 50% and the bottom 50%. And along with that is this idea of preventing these mergers and acquisitions to cause even bigger and bigger corporations. The thing is that the Google's place in the cloud computing world is not high. I think they have like 12% market share versus like Azure and AWS, which really takes the line share. And so they can make the claim that this acquisition wouldn't actually make them more of a monopoly player. In fact, they're an underdog, let's say, in this vein. So that might be the tack that they take. But what I find fascinating is that this is part of we've been talking about it for the last couple of months now. Google wants to be a big player within AI, obviously, and they sort of like want to be in control or have a stake in the entire tech stack for delivering AI solutions to people. So they have the consumer services side of it where they're delivering this AI information, but they also want to be part of the cloud computing and infrastructure and all that. And Wiz, they're like, what is it? They serve like 50% of the Fortune 100 companies. That's one of the reasons they're so valuable. They've increased their revenues over the last year dramatically from like 500 million per year to like or projected to be $1 billion per year.
Right.
And so Google's decided, yeah, we'll even overpay. I think they're paying 100% premium on the valuation of the company in
Well,
order to
yeah, just to unpack that a little bit further, you mentioned that there was potentially some regulatory concerns about the first bid that they had in 2024, which was at 23 billion, but now they're revising the offer at 32, which is almost a 40% increase in the offer. And I realize, as we're talking tens of billions of dollars here, it doesn't sound like a lot, but that's a massive increase in the bid without a clear, substantial increase in revenue. If they are on track to do about $1 billion in revenue, even in 2025, which we're not sure of yet, I think that's sort of the goal, or at least the estimate that has been put forth. They're still paying 32 times sales then in that regard. I mean, that's a massive multiple for a company that they are taking effectively a big risk on to add to their portfolio of cloud offerings. How are they going to get this money back is my initial question. And obviously investors are also concerned about this.
So I was looking through it, like I was thinking they might be concerned of what they will lose if they don't succeed in cloud and security and AI. Like what they will lose in that vein could be pretty significant. I mean, they could go the way of Yahoo if other things pick up above them. And they had promised like an $80 billion investment into AI every year for the next couple of years. And I'm assuming this 32 billion is being peeled off of that. Plus, Wiz has like a particular type of service offering. Like one of the reasons they are outpacing even their competitors is that, don't quote me on the specific details, but they actually allow you to connect to multiple different cloud services. You're not like siloed into one thing. And so people feel like there's less of a shift when you're going there because you have access to actually more than just what one entity is providing you. And I was listening to the announcement that Google made, and I'm always looking for the AI term there, and because cloud computing and security and all that, yeah, totally understand why they would want to have that, but that AI component where they want to be there for the inference training, they want to be there for the training of the AI models. To be able to serve the proprietary models, like they want this in part to serve themselves directly, not even as like a business to grow. They want that technology for themselves. So it's actually been pretty interesting. There is, when we take a look at the stock price, though, you'll notice that the news did not cause really any bump at all in the stock price. Google stock price still stayed low.
I mean, on the day of trading, it definitely did not look good. I had pulled up the chart myself along with Google Cloud's tweet on the subject, which looked a little concerning here. There was a bit of a pretty sharp pullback for the day, but you're correct. It ultimately found support for the next 3 trading days afterward. And this is starting to look more in line with the curve we're seeing in the S&P 500.
Right, so that means the market, in some sense, is not really betting on that this is like a great idea. Well, one, it might not even go through, right? So this deal actually takes place next year, and who knows if there's regulatory concerns there that they can't actually move forward with that. But if they can't, they have to pay out 10% of the acquisition, like $3.2 billion, as a oopsies that didn't work fee to Wiz, which is. I mean, I would want to be on the Wiz side where I negotiated $3.2 billion. I don't have to sell anything. That's pretty GD.
I'll take those deals all day long, and then
exactly. And so the market's sort of like, well, this is really. I mean, the dart's left your hand. It hasn't even hit the board yet, so we can't. They're not going to put money into that right now. There's also, I know the whole DeepSeek thing hasn't really taken root yet. Well, first, before, let me just play this for you, because this is someone who's talking about the idea of the difference between the proprietary LM models and then these open source ones. I thought that was particularly interesting. This is Kaifun Lee, who was talking about this, specifically targeting OpenAI. 1 second here. All right. You'll let me know if you can hear it.
In both US and China, the pre-training of a giant model has consolidated and is consolidating. And it's become clear that open source will be the winner. There's still many that will not concede, right? OpenAI, Anthropic, who build their businesses believing they can build a better closed model than everyone else. I think they got shocked when they saw a model as good. If you think about OpenAI's costs of $7 billion of operating costs in 2024, DeepSeek probably operated with 2% the operating expense. So the issue really isn't whose model is 1% better. I think they're all very good. But the issue is OpenAI's model even sustainable, right? I mean, you're spending $7 billion a year, making a massive loss, and here you have a competitor coming in with an open source model that's for free. And that company also is infinitely lasting because this founder has enough money to fund it at the current level and has reduced the cost of computing by a factor of 5 to 10. So with that kind of formidable competitor, I think Sam Altman is probably not sleeping well.
Yeah, well,
So the uncertainty that's still around the whole AI space, as far as the AI play, is so much so that like the wind has really been taken out of the sails, both in private equity and in financial markets, as to like, okay, we get the hype here, but where's the edge actually going to be found? Where are we actually recoup this money? What's the multiples we can actually place on this? People just don't know.
Yeah.
And we're seeing that also in NVIDIA and AMD and all that. The stocks haven't rebounded dramatically.
Well, yeah, and I think it's also just difficult to figure out how to actually invest in efficiency. It ultimately ends up being an R&D question rather than just saying, okay, well, the investment in hardware is a pretty clear objective and an achievable goal. All we have to do is buy more land, build more data centers, and buy more video cards and just get them out the door, right?
That's right.
That's an easy one for investors to wrap their mind around. It's tougher if businesses are trying to capitalize a ton of R&D expense to go into try to improve the operational efficiencies of these models. And I think it's harder for people to rally around because it's so unclear whether or not we can really accomplish that. DeepSeek represents an obvious push in the correct direction and can improve its operating efficiencies considerably. 2% of the operating cost is massive. I mean, most companies are looking for 10% improvements. So a 98% cut in operation costs, that's amazing. And where we go from here is the obvious next question. As we've talked about in terms of the paradox, though, as these costs come down to actually operate, the demand is still going to increase for the use of AI tools. So the wash is still going to be kind of interesting to see how this plays out, because even though we might be able to cut the operating costs down, if the demand multiplies by 10 or 2 orders of magnitude, 100 times greater than what we experience today, and more of the general population is starting to use AI tools, I think you're still going to need that infrastructure in place. So to me, it's interesting to see where this trade-off is really going to take place.
Well, that's why I think the long Google play, as far as the trade is concerned, still basically makes sense here, because there's one other component, which is the national security component, where the administration has clearly made this like the AI and national security issue, and the stakes are so high for this technology and the application that it's nation states fighting against each other now with this. And so when you're seeing the 32 billion acquisition from Google, and if you like were to assume, a nod and a handshake from government, like, we need you to do this. We need corporations to go out, American corporations to go out and actually become the big dogs. And don't worry, you're going to find your money on the back end. Well, now all of a sudden, 32 billion in the context of the government is backing you seems like nothing at all. I mean, they'll spend 32 billion they'll lose $15 billion and not realize where it is.
Sure.
And so if they're doing this play, it's a national security play, we should expect to see more of these sort of things. And you wouldn't necessarily have to worry about the downside risk to Google, because they would have access to, they would be pushed by the government in order to acquire more, to do more, to become bigger, and who knows what that might look like in the future. So if I wanted to play AI in a national security sense, then I would go to the biggest dog who's spending the most amount of money and the widest amount of field, and expect that to go up. But the fact that Palantir hasn't recovered yet, and that's also pure government play, I don't know what to think there exactly.
I think the problem with Palantir, though, has always been that they're already just considerably overvalued, and it's very much a growth stock that you have to project out their future potential on in order to ever consider getting your money back on what you're paying a multiple for today. Okay. With Google, though, it's a little bit different. I think you're paying a more fair price for access to Google today, for shares in Google today, And any potential upside that's perceived for this is largely going to be around how Google will continue to nail down, I think, larger Fortune 500 contracts. It should be fairly obvious that at this point that Wiz is really a solution that's meant for larger organizations that have security as a major concern. And so if Google's folding this into their GCP offering, they're interested in widening their net for the Fortune 500 competition landscape. And that's obviously going to mean pretty decent revenue for them.
Excellent. All right. Well, moving on to the second story. This has to do with strategy. Can't call it MicroStrategy anymore. The strategy. STRF or STRF shares. Is it a clever way to fuel their Bitcoin obsession or a warning sign? And could MSTR actions trigger the next Bitcoin bear market? Okay, fine. That's a sensationalistic lead in there. I said that for the MicroStrategy people out there, the strategy people out there. I said that for the AI. I said that for the algorithm. I don't know for sure if what they're doing is going to cause that problem. But Mike, I tried my best looking into the STRF shares and Strike and the common shares, trying to see it as anything other than a Ponzi scheme. I'm finding it very difficult. I don't like saying that because there's warriors out there, comment warriors out there, but they're issuing preferred stock now. So you have Strike and STRF in order to no longer or to limit the amount of dilution that they do on their common stock so that they can buy more Bitcoin. And why do they need to buy that Bitcoin? Because they need to pay the 8% and now 10% dividend on these preferred stock and keep the underlying, the MSTR, rising. So you need new money to pay for old money in a semi-complex financial scheme. I just don't know how that's anything other than a Ponzi scheme.
So I mean, my immediate question is, why would anyone buy a risky 8% debt instrument? By the way, I don't know how many people have ever even heard of a STRF prior to this. I haven't.
They haven't even listed yet.
Right.
It's going to be, yeah.
The perpetual STRF preferred stock sounds like the same kind of thing that would be presented in the 1980s when the mortgage industry came along and said, oh, we've got these convertible loan obligations that are available to you now, and we're effectively just tranching together all these mortgage together in one securitized product. Now, that has been successful for a lot of organizations that are looking to trade across, but this still feels like one of those custom types of instruments that seeks to serve a goal that only benefits the company and not the end investor. I'm failing to see the upside of using this type of instrument instead of just buying Bitcoin outright and owning spot. Like, can somebody help me understand this?
Well, the idea here is that if for some reason you're an institutional player or you're some corporation or whatever, and you cannot buy Bitcoin, that this becomes a better way of going about it. That basically he wants to be. There was an interview he did recently that of the 300 trillion that's inside fixed income, he wants MSTR. He wants MSTR to be 1% of that. So he's looking to just get, he wants people to buy a STRF as a fixed income play. You're not, in fact, because it's not even convertible to the common stock, you're not even playing it as a proxy to MSTR. You're just buying it for the 10% or the 10% dividend. And the idea here is that fine, because I was looking for the holes, looking for the benefits, looking for the disadvantages. They have enough Bitcoin in order to cover, they have $22 billion worth of Bitcoin now in order to cover all of the obligations for Strike and STRF. They can cover it all. And Bitcoin could fall 60% and they would still have enough in order to cover that. Fine. But I thought they were paying out the dividend or at least a large chunk of the dividend because of their core business, making $100 million a year or whatever. I thought they were using some of that to pay it off. No, they're not. They are paying it off by issuing new shares, new stock, in order to pay those dividends. So you look at that and you go, I just don't see how you look at that and go, this is a very safe investment. Now I get the 10% is there. Plus you even have this extra of if they miss out on any dividends, they increase the dividend for that year by 1%, all the way up to a cap of 18%. And it's like you're at the top of the debt stack, so you're before bondholders, you're before strike, you're before all the other obligations. So that that they could always sell the Bitcoin in order to get it. So they're trying to make this deal very, very, very sweet. There's even scenarios where if the stock plummets, the whole ecosystem, they call it the ecosystem, and the MicroStrategy ecosystem falls, technically your yield is higher because the stock price is lower.
Mhm.
But you have to trust that this Rube Goldberg, I'm not going to call it Jenga Tower because maybe it's not that weak. This Rube Goldberg machine of buy more Bitcoin is working in your favor. You were just saying it before. Let's say the worst happens and Bitcoin falls to zero, right? Or it falls to $1 or whatever it is, some low number. MSTR can, in a sense, in some scenario, always decide they're going to keep their Bitcoin. They're not going to liquidate it at all. They're not paying it any dividends. They don't owe, they're not paying out anything, and everyone who bought into the ecosystem loses their money. Them and everyone who bought the leverage MSTR, ETFs and all that, everyone loses everything. They still end up ahead by having 500,000 Bitcoin, and you lose your money for what risk? Like, why were you doing that? Just go get a bond at 5% and don't worry about this 10% on the stock that just showed up in the middle of nowhere for a guy who's saying they're only doing that in order to use your money in order to buy more Bitcoin. It seems crazy to me.
I think so as well. I think this one's a little too confusing for me to really understand the benefit of the instrument. And so the first thing I think of doing is always taking to Reddit to understand what those smart guys over there are really thinking about the whole thing. I like this comment that I see right away. The deeper he digs with printing money, the more concerned I am for Bitcoin's future. Either his system, which closely represents a pyramid, will collapse, taking Bitcoin with it, or he'll become the largest holder and just prop it up and control the price. Neither sounds like good options for Bitcoin.
Yeah. So, right. So there's this question of does what they're doing, can it cause a bear market? Can it cause a massive sell-off in Bitcoin? Or what I actually think is more likely, that I don't think it actually could cause a massive sell-off in Bitcoin. I think you get something like in Volmageddon with the VIX XIV, where the ecosystem blows up, and then you have some reflexive drop in the markets because it's correlated, and then also maybe Bitcoin takes a little bit of a dip. But even if they sold all 500,000 Bitcoin or whatever, they had 1 million Bitcoin and they sold it all at once, that's the market could absorb that. So I don't think it could cause a bear market. What I think it can do is be like one of those things that we saw for Celsius, Luna, FTX, where it's another nail in the coffin in a bear market. So their average price for Bitcoin right now is like $41,000 per Bitcoin, and essentially that's going to go up as they're buying more. Well, my low for the low that I have for my indicators for the cycle low right now is about 40,000. So let's say that keeps on going and we get to 250,000 Bitcoin and their average goes up to 50 or whatever. If we fall down to that low, I think in that last leg, now they have to do drastic things. They have to force sell a bunch of Bitcoin and whatever in order to get out of whatever mess that they're in. They just become one of these SBFs, one of these meme coins that just completely fails at the bottom of the market. So I don't think they could start that.
Well,
but there is an opportunity and Saylor even talks about saying, like, people should do this if they don't believe in the ecosystem, and that's if Bitcoin falls. When Bitcoin falls, because MSTR is a leverage play on Bitcoin, it falls even more. I think we saw that in 2022. Bitcoin fell like, I don't know, 50, 60%.
We just saw it. We saw it just the end of last year with a 47% pullback.
So then you can imagine that MSTR falls 80%. That's not like crazy. Falls 80%. That means Strike will fall even more than that. And if Strike, which is you have this, you can convert the you get 8% dividend, but you can convert it to every Strike to 0.1 MSTR. That's only worthwhile as the price of as MSTR moves up. If it moves down too far, you actually wouldn't convert because you'd actually be losing money. So you can imagine sentiment just being brutal within the space where you get Bitcoin down, common stock down, Strike down. it could be pretty brutal. And then they're selling Bitcoin in order to pay the dividend on STRF, if they're even paying that dividend. So you can just imagine this massive like FTX level like collapse that's happening. That to me seems like the case. And if you bet, I was looking at the options market, if you bet to short MSTR from, let's say, near the top of the market, you can do like around 2x, 2x on the low end, all the way up to like, more obviously if the volatility is higher. So you can actually, when I see something like this, I go, hey, now if you can almost get a signal for the market top, because we can see a little bit of that as liquidity decides to fall, then those options become a great play. And then I'm like happy that Michael Saylor decided to do that, because then I was like, okay, I can't buy Bitcoin options, but I can buy MSTR options and short it to the downside.
So is that the play here? What's your trade?
Yeah, so my trade is at I see zero reason to buy the common stock, zero reason to buy the new STRF. I for the 10%, I just don't see why you take on the risk. I see that you go, great, keep on building out the complex. If I'm wrong, the people on the other side will make money off my options and all that. And if I'm right, I can make 2x or more. I love this tweet that I saw from Whale Panda, who said that, I've said it before, that Saylor is going to bring the next Bitcoin bear market. I don't think it's the next Bitcoin bear market. This seems desperate. 10% dividend on 500 million translates to 50 million annually, payable solely in cash, and they don't have that cash, and they don't. So I'm open to being wrong. If you guys want to, in the comments, you have anything to say to Tom, you just don't know enough about MicroStrategy, I want to learn. Okay, I'm spending a bunch of time. I want to learn about it. Please give me something that tells me this is the best to do, better than buying the underlying, or anything else.
Sure. Otherwise,
AI,
I think you're right here. Puts at the cycle top for MicroStrategy seem pretty attractive.
Oh, and so if that's the case, the last thing I'll say is that then we'll get to see in the option space, we'll see what the skew as it starts to turn down. That might be a signal for a top. If the smart money in the MSTR, if you get this put skew at the top, then that might be a signal at the top. So we'll see.
Okay. Interesting story. That guy is always doing something interesting, I'll tell you what.
I just have to say that just to prove to the commenters that I'm actually trying to pay attention. So I was like, okay, let me feed this into AI. AI knows everything, and I want to serve my AI lord. I want to see what it has to say about this whole situation. So it's like, okay, what historical situation is similar to this MSTR thing? And it brought up conglomerates in the 1960s and 70s, where companies like GE, I forget some of the other names, where they buy up things, they use financial tactics, manipulations in order to buy businesses that are not even directly related to what their core business is, in order to become a bigger entity. And the idea is that they're more flexible. They could, anyways, you can imagine what happens there, the GE type of model. Sure. And then I was like, well, the problem here is that those businesses that they're buying actually had products and services that in and of themselves are valuable. Even if the businesses aren't profitable, they're producing something that itself is of value. Whereas that's not what Bitcoin is. Bitcoin is a financial instrument. So I tell this to the AI, and AI says, you're right. This is actually far more like, and guess the example that it brought up, mortgage-backed securities.
To my point earlier in the show. Very interesting.
Mortgage-backed securities, mortgage-backed securities, and then CDOs, and then CDO squares, and this whole thing. And then that ended up being this house of cards that actually crumbled. How did it crumble? When the asset, the underlying, the mortgage couldn't be paid, the analog here would be if Bitcoin falls. Right. So I'm not seeing where the maths here, where Bitcoin does its normal 80% drawdown, and MSTR walks through this perfectly fine. I just don't see this.
Yeah.
I just don't see it.
Yeah. Well, particularly since almost all of the value for MicroStrategy is now derived from their Bitcoin holdings rather than the actual underlying business. That's right. I don't see how they hold that.
All right. Before we jump into our final segment, let's take a moment to shout out Traders Post, the automated trading platform designed to take the friction out of executing your strategies. Whether you're trading stocks, futures, or crypto, Traders Post connects seamlessly to your broker or exchange, giving you the flexibility to automate your trades without missing a beat. If you're tired of being the bottleneck in your own success, it's time to let automation do the heavy lifting. Head over to traderspulse.io and see how easy it is to streamline your trading. Traders Pulse, because your strategy deserves to run at full speed. All right. Finally, the S&P's been on a roller coaster over the last month or so, and FinTwit is divided, Mike. Bottom or bust. We'll decode some of the signals, take a look at VIX support levels and Fed policy clues. So this last week has been pretty interesting, right? We're heading into Opex. Actually, today's Opex. The question is vol well supplied? Are the Vanna and Charm flows done? And what does next week look like? So just a quick refresher to some people who might not know, we're dealing with Opex's option expiry. Options expire all the time within the calendar year, but at certain periods of the year they coincide. The daily and the weekly and the quarterly coincide in at the same date, and that's today, Friday 21st. And there's 4 times per year that happens, and when that happens and that expires, that means people are in a sense unhedged in the short term. So that if there's going to be any catalyst whatsoever or any downside pressure, then the market could drop out, which is why most market crashes that you see happen in February and March or September or October. So what's been interesting is if you've been following SpotGamma over the last period or so, I really don't know. Between SpotGamma, Tier 1 Alpha, and Kem Carson, you get a nice breadth of options information. And what's been interesting here is that people have been talking a lot about online about this idea that there's $4.5 trillion worth of notional option volume that is clearing today. But SpotGamma, they talk about this idea that if you delta adjust that, it's only about $1.5 trillion worth of option notional value, option value that needs to be decay today. That means we're about 50-50. Like calls and puts are about 50-50 in the market. If we were screwed dramatically in one way or another, then there would be this case for the market to drop or to rip. But since we don't have that, what we're getting now in this bounce is as these options expires, the market makers can sell their hedges. So they've been buying in order to support the puts that were there. They can sell off, and so you get this range that the price stays in, which is what we've been seeing. And so I just want to say one last thing. There's the JP Morgan, is it a straddle that they have? I forget what large put position that they have on, or some sort of complex option structure that makes it so that these options levels, these major option levels, basically are magnets for the price, and it pulls the price between these levels. That's a quick pitch of what's going on right now.
That's fascinating. And as usual, it's always interesting to see how this lines up with technicals that I try to keep an eye on. Just to pull up one chart that I know we've brought up several times on this show. The first thing I'm always looking at is overall what the Shiller PE looks like. And I think I've mentioned this a few times here. Anytime in the past that we have seen really elevated valuations for the S&P 500, there's usually been a pretty big pullback that follows it. We saw the dot-com bust where valuations were in the 40s from a price to earnings perspective. We saw the 2018 pullback. We saw 2021, and now we're right up in this range again. What I find interesting is we were right up at 37, 38 in terms of average PE, and now this is the start of what I would feel is like a larger potential pullback in overall valuations, getting closer to a healthy range. There's still more room to go here to get us closer to where I would say is a more modern valuation range. I would hope to see most of the S&P 500 companies somewhere in the 20 to 25. I don't think we get into the 15s where that feels like a traditional metric or rubric for investors in the past, because there's so much growth involved in US tech companies now, and they make up most of the index. But still, 35 is a fairly overvalued market. There's a couple of issues with, I think, the state of the market at the moment too, which is one of the key variables we're going to need to be looking for in terms of a bottom or a rally in return is what earnings revisions start to look like going forward. And we've got a couple quarters to really listen to the major S&P components and where their earning revisions show up. And we're going to need some growth-related policies to come out, tax cuts, deregulation, things like that. But one of the other things that I'm really concerned about is the fact that the Fed decided to remain paused. And obviously, higher interest rates are a cost burden to most businesses, especially as they restructure their debt. That's going to continue most likely to be paused even into May. Right now, there's about an 86% chance of a pause on the May 7th meeting. And then I'm just now seeing this curve start to shift a little bit, but in the 18th of June, the futures market is predicting about a 67% chance of finally seeing a cut. So we've got a little bit of time before we start to see 25 basis point cuts. It's going to take a little more time to see some of that cost come down even further. We're at least 3 or 4 quarters out from earnings revision starting to look much, much healthier. So while from a technical perspective, just looking at the S&P 500, let me share my window here. We did pull back enough to say that we're almost at that 0618 line on the Fibonacci. If we're looking at 510.27 being the bottom and the peak being somewhere around here about 613. We touched almost that 0618 line. Looks really good from a technical perspective, but this line here, the 200-day moving average, is the one I'm concerned about. We're starting to see the formation of what I would consider a pullback, and obviously next week's trading week will be the confirmation of that, but we could barely even get back over the 200-day moving average. I'm really not expecting that we see a continued rally from here. I would need to see a lot more evidence from an earnings perspective and evaluation perspective, and we're just not in that territory. In which case, I actually think that we could see a larger pullback down to the 520 range or even potentially 540.
Right. So I had that level there too. I have the 52.73 as the target for what I'm aiming for, all the way down to around 52.35. So that lines up close to what you're talking about there.
Yep.
I just wanted to bring up here just a couple of points because one, I'm going to play just a quick interview with Ken Carson and Mike. I forget what his other name is, his last name is, but they talked about this. This is from the 14th, talking about what this week might look like, and then what to look out for like next week coming up right now. So I thought it was interesting. Let me just pull it up real quick. If you guys are not following Jam Croissant on Twitter, you're doing yourself a disservice. All right.
Also, please do us a favor and pronounce it with a French accent as well. Thank you for that, Tom.
It just comes naturally.
Of course it does.
That so many parts of the bond market, even high yield, junk bond.
You know, there's a lot of inflation out there. So today we have guest inflation. Instead of one guest, I have 2 guests. Let's get right into it. We have Mike. We have Chem. What do you think about volatility here? Is it giving us any clues? Not volatility like choppy, like implied market option volatility.
Well, we had a pretty good, the administration came out and really told you what they were going to do. They're trying to take down the economy, take down the market. They weren't going to stand in the way. So
we're going to look at that in a second. The administration has told us that what they want to do is take down the market. And they have been saying that.
As well, documented. And so the volatility just hasn't been there. It's been a slow burn move down. The problem with slow burn down is if you have a hedge, it's not helping you here. And sometimes that could be the pain trade. Not big vol explosion that everybody thinks. And for a lot of these hedge funds.
So that bounce you were showing on the SPY, you're like, it hasn't reclaimed. But because it hasn't reclaimed, calls are not going in the money and puts are not going in the money. They're bleeding out theta. And then with options expiry, which expires now, there's a bunch of people that go, damn, if we were just down another 3%, I would have made my year. And other people, we're just up 3%, I would have made my year. And the market is always trying to do the thing that hurts you the most. And so this sort of like weakish sort of bounce here, this dead cat bounce over here, is to be expected. And this is called on the 14th. Right?
Funds that are having the multi-strat, that are having problems, that's probably the worst case scenario as well, because as the vol gets compressed, things start moving away from each other. You get dispersion and a correlation breakdown. So I think that's a little bit of what's going on. It's actually a pain trade as vol comes lower.
What do you think?
I think the correlation story is a big part of the story. We've seen about a 10% sell-off in the market since mid-February. Now, what we'd seen prior to that, it was just saw a market where, S&P 500 would be not moved that much, but you'd see big moves up in Amazon, big moves down in Tesla. That compressed kind of index volatility. When volatility gets correlated, things start moving fast, and that's sort of what we saw over the last month. Now, today, we're rallying. We're seeing volatility come in. We're going into a weekend. things are quieting down for today, but I think we've got some catalysts in the future that we got to look at.
You know, just because the big boys are doing something, does that mean they're going to be right?
Oh, absolutely not. And actually, what's happening right now is the big boys are having to delever. They're being forced into these trades. So this is a deleveraging event. Like Mike said, I'd be a little careful here. I mean, I think you can get a little rally into the weekend. These are Vanna charm flows, and we talk so much about these buyback of deltas as vol decays. We're heading into a big quarterly March Opex. That matters. The skew decays, and that sends deltas back into the market. But those are structural flows. And when those go away, you may not have anything behind it.
You know,
So that's the most important part there, that these structural flows, that it's market makers that are not trying to make any directional bet on the market at all. They just have these puts that or options that are sold on one side, and they have to balance their books by hedging their position, and they hedge their position by buying or selling the futures depending on what asset is being what options they sold. And so as these get the options expiry and those disappear, well, they don't need those hedges. In fact, if they keep those hedges on, now they're no longer delta neutral. So they have to then they buy it back for, we saw it during the week, it buys back, and then at the end they go, okay, well, if this is all the buying pressure that we've had this week, and it's not being supported with other people buying in at the same time, well, what's the story going to be like next week when the flows are gone? These Vanna and Charm flows are done, like they're done. So we'll see what happens. I mean, Sunday night, I'm going to be looking at the futures market to see how this is open. And before that, I'm going to be paying attention to Bitcoin to see what that's doing, because that'll front run it. And we've seen this sort of like eke out in Bitcoin too, where it's basically been behaving in the same way. And so we'll see Saturday how, tonight and Saturday, how Bitcoin, actually, no, forget it. Saturday, Bitcoin doesn't do anything. Sunday morning and Sunday during the day, we'll see that. And then we'll see what futures open up later on. Oh, you're muted?
It's going to be an interesting trading week next week then, for sure.
That's right. Also, so I was wondering, okay, what's the catalyst? Like, I don't know what the catalyst is. I'm not sitting, there's no obvious catalyst to me. And Brent, shoot, I forget, SpotGamma, remember his last name? Brent K is all I know him as. He makes the case that tariffs, the April 2nd deadline that Trump has provided for tariffs, might be one of the things that's causing some volatility within the options market. So I just wanted to play real quickly just a couple of points that he's made. One, because I think it's super important. We can only give you like a general overview of like options information. Like neither Mike or I are experts within the option space, but it is super useful to, if you have a head for it, to use it as a confluence for your own indicators for what you're watching, so that you could contextualize the market movements that you're seeing. So we already saw Ken talk about the positioning. Here we actually see the SpotGamma tool and how they're seeing the structure of the market here. So let me just play this real quickly, where he's going to talk about the VIX term structure that we're seeing right now. And this is from Fed Day, so that was Wednesday.
No audio.
Oh, that sounds too low to me. 1 second. All right. Tell me if you can hear this.
Zero DT option, elevated
Yes.
short-term vol because of FOMC today. So that zero DT option is pegged.
So this chart that you're seeing is the volatility surface for VIX. So where he's pointing at is really high because volatility is high, and then later on it ebbs away. But there's these kinks that are happening within the structure later on that he's going to talk about.
So far, we're still pricing in probably about 1% of move, because the Fed's about to start talking about here 45 minutes. And then if you look out in time, the term structure is actually pretty flat. And what I think is kind of unique is you get this little bump here, which is right around the anticipated tariff date. And so what this tells me is that we could get a release of vol around the FOMC, but then we're still going to have some stickiness because of this tariff overhang. And this tariff overhang really seems to be, a critical development here.
So that tariff overhang is causing a little bit of more uncertainty, and all you really need in this window of weakness here until options start picking back up is any catalyst that starts the downside move while people are no longer protected, and they're no longer protected right now. They have to put on those positions next week. And so if we jump just quickly to Actually, no, we don't have to go through all that. Basically, he makes the claim that
Had this low
support
stability.
and resistance levels are have been maintained this week because of these major options positions that have been on. So here around the 5750 level, and then lower down here because of JP Morgan strike at 5500. And so we've had this bounce basically in this range as the price is being squeezed between here. And if we had a big catalyst that would have pushed us into one or the other here, we would have rallied up, or we would have crashed down, but that didn't happen yet. And so he goes on to actually say
Don't
this
think
last
so.
thing that
But that is the extreme sentiment.
if we take a look at the what is it, the IV rank for a bunch of assets within the space or stocks within the space, he's seeing here when he's taking a look at crypto that MSTR, Mara, which is a miner, some crypto stuff is actually there's not a lot of negative sentiment within the option space, which might say that we might get a short-term bounce. And I've actually been waiting for expecting a short-term bounce in Bitcoin to the VWAP level at 1 second, around 88. So 87.7, 88. I've been expecting a bounce there with a short then down to 74. That's what I've been anticipating.
That feels right.
And so I like that the option space is sort of like confirming that we had this weak demand, maybe a little bit of a bounce, and then, well, if there's no supportive flows that come in, look out below. We should get another leg down. And then if Trump decides, hey, let's go big or go home or whatever on April 2nd or anywhere near there, who knows if that ends up being a catalyst lower. Now, if we get past that, if we get past, April 2nd, April 5th, 7th, and we haven't had any big thing down, then I go from your liquidity indicator, Mike, that I use an offset for that for 78 days. And that suggests that we then take off and we get a nice rally up, basically all-time highs for Bitcoin and S&P and NASDAQ. And then we roll over as we head over to June. And it turns out, no, actually, things are not as good as everyone would hope they would be, and then we roll over into the recession second half of the year. That's my base case.
Okay, so you're still sensing that there's some potential for a recession there.
It depends on the liquidity. So because actually, let me just pull it up, because frankly, your liquidity tracker has been like invaluable to me, especially with the offset on it, where sometimes to the day it calls bounces. Let me just pull it up here real quick. All right. So if we head to Bitcoin and we take a look at M2, I use a 78-day offset, which would suggest that here around April 1st, April 2nd or so is the bottom for basically liquidity, and then a ramp up, and that liquidity, we even made a new all-time high for liquidity. So I'd expect that we get back to all-time highs for Bitcoin at least, and usually with this sort of momentum, with propelled by calls and leverage, you can get even higher than that. So even though this is as high as it was over here, we're starting from a higher low versus over here. And so I totally think we can get 150, 200,000, even 240,000 on Bitcoin. But when I see this roll over, then I'll know, okay, that's where I'm going to start looking for a peak in liquidity. The issue is that if the Fed then starts, you said the Fed was we're moving towards potentially a cut from the Fed in June. So what does that do? The cut in Fed for June, usually when the Fed cuts, for the cut, it makes everyone panic. The market falls, and then it only really starts picking up like after that point. So I would expect a drop in June, July, August, pretty significant drop into the next summer is a low period of volume for the market. And then the next quarter, the options expiry is September, right? So that could all play together to have this massive drop that starts, June, July, and continues all the way to the end of the year. and that would cause a recession within markets.
I could see it. I mean, especially as the second and third rate cuts unfold in July and September, and by October, if there's continued rate cuts, I think that could be the early signal. But I think that's kind of the whole point here. Is it's hard to tell where markets unfold here and how much further they pull back over the next 3 to 6 months. But I think my confidence is stronger that we do see continued pullbacks rather than a rally from here. I'm not convinced that we see continued upside yet.
I think we would have seen way more bullish movement at the end of this week if we were actually going to be rallying up.
Yeah,
like we should be pressing on the highs and closing on the highs of the day, and we're not. I mean, it was one of the weakest dead bounces I've ever seen.
Yeah.
We'll see.
Okay.
All right. That's fun. Anything else I wanted to bring up, or any signs that you're seeing for you're saying that if the market does go down, though, what's your invalidation criteria? Like, do you have a time and date or a pricing on the S&P?
I mean, generally, when it comes to the S&P 500, I'm looking for where we close above or below the 200-day moving average. So I would want to see us invalidate if we push right back above 575, close above 575 for at least a couple of days. That would start to give me some confidence that the bearish thesis is starting to be invalidated.
Understood. Okay, perfect. So you have a price 575. I have a date April 2nd, and then if neither of the doomsday scenario happens, then you don't have to wait for the next after hours. Maybe start buying calls.
I could definitely see us closing above 575 by the end of April, though. So my date would be a little bit further than yours.
I see. Okay, cool. All right, excellent. Well, that's it for After Hours for this week. It's been a pleasure to be with you guys. Always fascinating. Never really a dull week inside of the markets, but that's why we're all here.
That's right.
We'll be back next Friday for more After Hours. Don't forget to pick up some of our other shows. We have Office Hours on Tuesday if you're looking to get into automated trading, and you should if you want to be a good trader. You want to know a lot more about automated trading. And if you have a little bit more technical-minded slant, you can take a look at Blueprint, where we go over some tips, tricks, and programming hacks in order to get more out of your automated trading strategy. But until then, wish you guys happy trading and great weekend.
Cheers, everyone.